The point I'm making is that it'll scare you out. In other words, it can make these very, very big moves very, very quickly and exceed the expectations of the most ardent bull at times, only to do what it just did on this open, which means we went from, I think, 84 in the access market, and then by the time it got to the New York market, it already dropped like $10 or something. We're still doing this recording as that day's trading
Yes.
has really got several hours to go. So who knows where it's going to close
Yeah.
at today.
Yes.
So I'm really not that surprised. Personally, I think silver's kind of gotten ahead of itself. We've had these massive moves up, but if silver goes to 100 and you start filtering out at 75, and then it gets to 85 and you sell some more, and let's say it gets to 90 and it never gets to 100. Well, you have to have a plan on the way down, because you don't want it to go from 50 to 90 and back to 50, and you rode it all the way up. You're fine. You're one of those people that bought it at, near 50.
Silver just made a violent move, and this is exactly how investors get shaken out at the worst possible moment. Veteran precious metals analyst David Morgan is sounding a serious warning. Silver is entering a phase where prices can surge far beyond expectations and then reverse brutally, without notice. If you own silver or gold, this is not the time to trade emotionally. It's the time to understand how these markets are designed to punish impatience and how disciplined investors survive what comes next.
So if you are someone that's exporting silver out of China to India, as an example, and you're doing it right now, what I'll call the black market or the free market, how you want to term it, then now they're going to try to license, China's going to try to license everyone that is exporting silver, and there will be restrictions on it. So they're getting a better handle on what is leaving China, but it's not closing it down. It's not stopping it. It's nothing like that. Don Durrett, I think, addressed this, and he's pretty well known on X and other platforms, and others have. A lot of the stuff is getting, especially new silver investors or even old ones, have been in the silver position for a long time, and they're just really fatigued because they've waited for so long. And here we've got a lot of enthusiasm, a lot of movement, a lot of momentum, and every little piece of information, true or false, gets them overly excited and puts it in a context that is really unrealistic. So yes, the licensing will take place. That's a fact. Will it have a huge impact on the market? It will not. And silver and gold are very underpriced versus the stock market. So let me go on just a minute longer. If you were in the Weimar Republic during a true hyperinflationary blow-off, a hyperinflationary depression, the stock market went up and up and up and up. So people thought, oh, I'm doing good. I don't have my money in the bank, at least in the stock market. And it protected them somewhat. But if you did the gold stock ratio, what you would find was gold and silver were the only thing that kept you above the inflation rate. Stocks did not. So from that, we could say perhaps that we could see a blow off in the stock market going up and up and up, but people feel good because, the dollar is declining or gold and silver are moving quickly and they're okay because the stock market keeps going higher. But relative to gold, that's what we want to look at. Where is it? And that, again, is what you really need to measure. That keeps you grounded. That keeps you in a basis of the real value versus what is the paper price. Not saying that when you cash out, you don't get, fiat in exchange for it. I understand that. But it's what is the ratio? Is my silver overvalued in real estate? If it is, well, maybe I should take a look at selling silver for real estate. Is it overvalued to stocks? If it is, maybe I should consider selling silver or gold for stocks. The central banks buy gold. They've been doing it rapidly the last couple of years. That trend continues. And it really is the monetary stability, whereas silver as a partially monetary metal is much more volatile, much more emotional. It's sort of looking at the Dow Jones versus the NASDAQ. I mean, if you remember in the tech wreck, I think the Dow went down 20, 30%, if I recall, but the NASDAQ went down something like 80%. So that's a good analogy for the gold and silver markets. So I think your core position, especially the older you get, should be gold. As far as silver is concerned, I think you should treat it as more volatile and act appropriately. So let me just outline what I've done for many years, and that is my core position is like 75%, and with 25%, I trade around that, trying to catch, Not day trades. I blow myself up doing day trades, but position trading I'm pretty good at. And that is where you take, a breakout at 50 and just hold on to it until it exhausts. In other words, you keep moving your stop up as the market moves in the direction that you thought it would. So that's something you can do. It does enforce the idea of taking a profit. Now, I've got a core position that I'm not going to sell until I think, we've gotten there. And just to add on to that a bit, it's very difficult to measure where do I sell my silver, where do I sell my gold, it's silver included, that you will see, a back and forth at some point. And I've warned everybody, once this bull market starts again, that the primary purpose of a bull market is to shake off as many investors as possible all the way up, so that whenever this market peaks, there won't be too many that rode that bull the whole time. And I am fairly certain we have not seen the ultimate peak in silver yet. There are many that are advocating that's the case. And, you should take all of your silver profits and move it into Bitcoin and all kinds of stuff's out there on the web.
David Morgan explains that silver is uniquely dangerous during powerful bull phases. Unlike gold, silver can move extremely fast, making massive upside runs in hours, only to collapse just as quickly. We saw this recently when silver surged aggressively in early trading, only to drop nearly $10 by the New York Open, all within the same day. These violent swings are not accidents. They are the mechanism that removes emotional investors who chase price without a plan. Morgan emphasizes that the long-term bull case for silver remains intact, but warns that silver can temporarily get ahead of itself after sharp rallies. Investors who wait for a single, perfect price target often end up riding gains all the way back down. That's why he stresses scaling out in stages, taking partial profits at higher levels, and most importantly, having a downside plan. Without one, volatility doesn't just test conviction, it destroys profits. The discussion also addresses confusion around China licensing silver exports. While headlines sparked excitement, Morgan clarifies that China is not shutting down exports. The move is about tracking flows, not restricting supply. The real issue isn't supply panic, it's investor fatigue. Longtime silver holders are worn down after years of waiting, while newer investors overreact to every headline, true or false. That emotional mix creates unrealistic expectations and dangerous positioning. Morgan then reframes valuation entirely. He explains that gold and silver are deeply undervalued relative to stocks and that nominal prices are misleading. Using historical examples like the Weimar Republic, he shows how stock markets can rise during inflation, yet still lose real purchasing power. What matters is ratios: silver versus stocks, silver versus real estate, gold versus equities. Those ratios keep investors grounded in real value, not paper illusions. Central banks understand this, which is why they continue accumulating gold. Gold provides monetary stability. Silver, by contrast, is far more volatile and emotional, similar to the difference between the Dow and the Nasdaq. Morgan's own strategy reflects this reality. A core position, largely gold, combined with a smaller, actively managed silver position, using position trading and trailing stops to protect gains. He closes with a critical warning. The purpose of a bull market is to shake out as many participants as possible before the final peak. And according to Morgan, silver has not reached that peak yet.
I mean, it's very, very common in the futures markets, all of them, that if things get out of control, the exchange will increase margin requirements and flush out the weaker hands that don't have the cash available to meet the increased margin requirement. And that happened in the palladium market years ago. I'd have to look. I was much younger at the time, but believe it or not, in the palladium market, when it really took off because it was physically driven, what happened in palladium was it was at a really decent price. It was a much lower price than platinum. Ford Motor decided to switch their catalytic converters from platinum to palladium. It was a cheaper way to go. So they just, called up and said, "Look, we're going to buy this much palladium." Like, what? We don't, that much doesn't exist. And it did, but barely. And I'm exaggerating it a bit, but the palladium market just took off. So what happened was margin requirements got lifted and lifted and lifted. And at the top of the market, you had to put up 2 times the cash price to keep a futures position, which is ridiculous. So yes, it does take place. Yes, there's a reason for it. I'm not going to evaluate whether it's right or wrong. You can make up your own mind. No, I don't think anyone has a real answer. I'm sure people that are, metals dealers will know. But as that opportunity unfolds, and if it's real, then those arbitrage opportunities don't last very long. In other words, if it could be done, and I'm not saying it can't, that gap would close pretty quickly. And since it's not closed on the physical end, it's closed more or less on the paper side, then that brings into question what's really going on. And I suspect that there's more hype in the market than that we need. There's a lot of misinformation and what the true allocations are. We do know for a fact that the amount of silver on the retail side has been net sellers even now. So there's refiners that are backed up that are only taking $9.99 buying silver. They will not take, silver coin because it takes a longer time to refine it. What's being taken into the refiners is being produced into 1,000-ounce bars, good delivery bars for the CME and the LBMA and for Shanghai. And so there's a bit of a backlog there. So will we get equilibrium? And the answer is, I don't know. I suspect that we will.
Silver's volatility isn't a flaw. It's the test. Those without discipline will be shaken out. Those with a plan will survive and thrive through what comes next. If this breakdown helped you think more clearly about silver and gold, like, share, and subscribe to the channel. Turn on notifications so you don't miss what's coming next. Stay sharp, stay disciplined, and stay ahead of the volatility.